Record. Yeah. Dear all, welcome to this biannual call, and thank you for joining us, and more so for trusting us with your investments. Before we begin the call, I would like to introduce you to the team at Latent. You already know Divyansh and myself. We also have on the call our team members, Nishant, Riya, Suraj, and Paresh, who's soon to join us. We trust you've been receiving our quarterly newsletters as well. If not, please do reach out to us separately and we'll ensure that the email ID is correctly included. For the call today, I think we are keeping it quite open-ended. We want to spend a few minutes for a review of the current year and our previous year. More importantly, spend some time on our thoughts going ahead, how we look at the markets, followed by Q&A. I'm sure you have a lot of questions that are running through your mind as you look at markets and the volatility. If we look at last year, where we left off, we held our last call in around April of 25, and this was our last slide that we presented. Obviously, markets have been very uncertain, very volatile, and there have been a lot of variables that have that are unknown and are relevant for that are impacting companies and the prices thereof. On the back of these uncertainties, markets also saw a good level of correction in the end of 2025 and early 2026 fiscal year. We actually use these market drawdowns to increase allocations in our portfolio. And happy to say that probably for older investors, we are almost 80-85% deployed. For new investors, the deployment would be much lower, in line with our framework of waiting for better opportunities to enter into stocks. Last 1 year, if you may see, has been quite different from the previous few years post-COVID. We've seen the Indian markets broadly consolidate in the last 1 year from from December to current November, and they've actually been quite underperforming global markets. Gold, of course, has seen an outstanding run. It's been a winner all along, but also have other international markets, including the US, China, Europe. They've done far better than Indian markets. In particular, if we were to really look at markets within India between large caps, mid caps, and small caps, large caps have broadly done better than mid and small caps. And actually, if you were to peel a couple of layers and look at companies across the board vis-a-vis indexes, you can see from this chart that the broader market actually has seen a fair level of pain. The disparity of performance between different companies, particularly within the mid and small cap, is very stark. For example, almost 60% of companies that are listed in Indian markets with market cap of above 1,000 crores have delivered negative returns in the last 1 year. 30% of the companies actually have lost more than 20% of their stock prices. A large part of this brunt has been borne by small and mid caps. But we've seen an impact also on the large cap side. At Latent, we've been a little cautious and often reluctant to invest last year, and that was quite apparent from all our newsletters and the discussions that we've had with you. That helped us. We were patient and waited for our prices. And we were therefore able to avoid the stark drawdowns that a lot of companies have seen. If we look at Latent performance, I think last year we've delivered around 8.4% returns on the equity portfolio, as against a BSE 500 of 6.3 and mid cap of negative -5%. For the full year basis, in 25, if we were to look at the year-to-date performance for 26, the returns have been 16.4 and 29.9. From inception, which was in April of 24 for us, the returns have been around 26.5% for our investors. We will come to the multi-asset performance in later slide, but there also I think the performance has been fairly comfortable from our perspective. Having said that, this we still believe is a very short time frame in a long game, and therefore we do not want to read too much into the performance numbers or the performance data for our fund. If we were to look ahead, I think we've tried to segregate it between our views on the global markets or the global macro and our view on India specific events. Globally, we are seeing several headwinds. There's been the tariffs, deglobalization, localization of manufacturing, uncertain geopolitics, stagflation in the US, interest rates moving up both in the US as well as Japan. Valuations across countries, across sectors have been fairly high and sustained there. And obviously, unemployment on the back of AI has been another significant overhang in the minds of people. On the other side, we have several tailwinds. Oil prices remain fairly low. Our view is it's probably on the back of geopolitical complexities that are there and substitution effect against oil that industries are working on, including likes of EVs, etc., or renewables. China plus one manufacturing is pushing the capex cycle globally, including India and particularly in the US on the back of tariffs. AI-led and tech-led productivity improvements are fascinating and quite large actually. And finally, I think it's also on the back this currency debasement. What we talk about is one of the largest factors we believe that has been playing out in the markets over the last many years. It is now the whole trade is now actually kind of named as the global debasement trade, where everything is going up against fiat currencies. You've seen movement in gold prices, silver prices, copper, other commodities. Market valuations remain quite high. And our view is that this debasement trade probably will continue as governments and countries would probably be unable to rein in their deficits, and printing of currencies will continue at a continuous pace over the next few years. If we look at India, I think our view is, yes, we do have several headwinds. Tariffs have really affected labor-intensive sectors such as textiles, gems, and jewelry. UPS crossed 90. There's been a continuous FI outflow from markets. Governments have been fighting elections on the back of freebies and free transfer of money at various levels. We also had a small shock on the MFI lending side last year, which led to a credit squeeze from the RBI and stricter monitoring and tighter norms around lending, which led to a credit challenges in the country. At the same time, companies have been operating at peak margins and pretty high valuations. All this headwinds are actually on the other side. We have some pretty interesting tailwinds that are going on in the economy. Monsoons have been quite good. Rural recovery has been fairly decent. Wage growth has been quite at a decent place on the rural side, particularly. Income tax benefits in terms of income still 12 lakhs not been taxable is a huge boost to consumption. The recent GST deductions are leading to demand on the consumer side. RBI has also reduced interest rates now, and there is loosening and availability of credit is improving. On the manufacturing side, the PLI push, the China plus one story is also playing out in the country. While it took its while to get X in order, we are seeing more and more companies looking at setting up manufacturing bases, and there are some steps already towards it. So net, our view is there could be a decent cyclical uptick in the economy, And while the valuations still remain high, hopefully earnings will likely play a catch up to these high valuations, which also means that if companies don't perform, I think you would see some pretty sharp reaction in the stock prices, which you are seeing in many companies. As an investor, I think this is a classic case where one would really need to focus on bottom-up stock picking rather than taking sectoral calls. I will now want to hand over to Divyansh really to walk you through Latent, what we've been up to, how we've been looking at our portfolio and investments. Over to you, Divyansh.
Thanks, Bhavin, and thanks again to all the investors and friends who joined us today. As Bhavin mentioned, the last 12 months have been sort of a mirage at index level, not much pain, but portfolios have been hurting. And as we mentioned that luckily for us, being circumspect last year, I not deploying in a hurry has helped us to tide over these pains. And hopefully going a bit aggressive in the last few months should pan out well for us as earnings catch up. So let me summarize what worked for us in the last 12 months. Um, it's similar to what we had presented last time, and it probably remains true that we stuck to our framework while having a flexibility, managing risks, and avoiding FOMO. I'm moving to Our BMV framework remains a North Star. We invest in businesses which are present in sectors with long runway, with demonstrated leadership, investing with management who are competent with ethical teams and a strong capital allocation framework. However, or rather, investing at favorable valuations, no matter how good the business, overpaying kill returns. We have, as of 30th November, uh, created a portfolio of about 20 stocks, uh, which, while being concentrated, are equally well diversified across various dimensions of sectoral exposure, forex, interest rate risk, as well as having a good mix of value as well as growth. In the portfolio, autos performed visible now. So yeah, as what I was saying in the last year, autos performed quite well, while banking or BFSI domain provides value with compounding potential as well as a downside protection. Uh, yeah. Now, what we didn't do equally mattered. We avoided businesses we didn't understand. No IPOs, no EMS, no energy transition hype cycle sectors. We stuck to a negative list of PSU real estate, certain promoter groups or entities. We skipped order book businesses or businesses which are expected to see an overcapacity or oversupply risk, such as solar panels. And we didn't follow model portfolio. We buy at a price and not on autopilot. What we did do also equally mattered is that we waited for a price. We remained price conscious. We wait patiently rather than chase deployment targets. And as I mentioned, that we built a concentrated yet diversified portfolio, which is leading to a portfolio which is greater than the sum of its parts. Uh, Obviously, there have always been learnings on as we scale up, and we also had our learnings from last time, and happy to report that at least we believe that we improved on those areas. On exits, we have had 2 or 3 exits during the year, and we exited our positions quickly rather than to get anchored to a particular price point. And similarly, on sizing, we became more aggressive in taking initial positions for investors, which led to old investors being about 80%, more than 80% deployed, as well as new investors also seeing a decent deployment levels. How do we see the next or rather the calendar year 26 recovering? 4 broad themes, if I may say. Cyclical recovery given by the RBI and government stimulus with China plus one gaining ground traction. However, externalities will remain volatile due to tariffs and geopolitics, which will keep on creating noise. earnings will matter, right? So I was reading a line yesterday, which I like to quote, is that when a high valuation stock delivers mid valuation outcomes, the correction is violent, right? So any surprise or negative surprise on earnings can lead to a quite a sharp downtick. However, debasement as a trade may keep the markets uh, elevated, right? Bottom line, we don't know how it will all play out, but rest assured that returns will see a volatile trajectory and may potentially remain muted as well. Our focus remain unchanged that we invest in agile businesses running sustainable cash generative businesses. Uh, Coming to multi-asset offerings or multi-asset scheme, a quick update or introduction to people who might not be aware. In multi-assets, we play a role of a asset allocator, underlyings being ETFs, mutual funds, or passive instruments, but not any direct equity exposure. And thus we take a call on the asset class and gain exposures to those asset classes. Recent changes that we have done, or other changes that we have done since April. Bhavin, move the next slide. We increased our exposure to flexi caps or active flexi caps, increased exposure to REITs and gold. And we almost exited arbitrage funds because as the interest rates have come down, on a post-tax basis or even on a pre-tax basis, arbitrage funds are no more a good fixed income equivalent. Additionally, we also reduced some bit of exposure to NASDAQ, uh, which was driven due to a lot of premium that existed over the existing. So let me just re-explain. Due to RBI's limitation on Indian funds not allowed to invest outside, the ETFs are right now trading at about 10 to 13% over their base value, right? So the way to see is that we have probably booked a bit of that profit uh, in our for our investors. From starting till right now, we haven't taken any mid and small cap exposures as the valuations remain elevated and we are waiting for a better entry point. If you look at the overall portfolio, sorry, Bhavin, next previous slide only. If you look at the overall portfolio with index of 48 flexi or 22 and half of balance, we have about 75% equity exposure, which goes with the framework that in the long run, money is made by remaining invested in equities. And therefore, the multi-asset scheme framework is also biased towards equity in the same way. Next slide. Coming to performance, as Bhavin had mentioned that generating wealth or managing wealth or compounding wealth is a long game. And therefore, performance should not be evaluated on a very short time frame. However, um, last year in the multi-assets also has been a good year. We had mentioned earlier that whenever investors gives money, we park it in liquid funds and over a period of time, we move it to various asset classes. And therefore, over a period of time, the gap between the benchmarks and our performance should reduce and hopefully exceed. Happy to report that at least in the last 1 year, we have given about 12.1% return against the 8.8 of the markets or the benchmarks. I'll hand it over to Bhavin on what to expect in CY26 on multi-assets and concluding remarks.
Right. I think, thanks, Divyansh. Our view on CY26 is we will probably continue to do the same what we've been doing. Given the way the markets are, we do expect return expectations to remain a little muted than not. We will continue to wait for opportunities to initiate exposure to small and mid cap. We do want to have exposures there, but we are very selective and we will want to really wait for better entry points. Till that time, till the time that markets give us those opportunities, we will continue to maintain a bias towards large caps, gold, and REITs. I think overall, if you ask us, one underlying theme that drives our investment thought process as of this point in time is uh, around increasing equity exposure, is that the debasement rate that has been on for probably more than 5 decades. It's actually now that people have given it a name, and now they call it the debasement rate. But fiat currencies keep losing value, and the only way to protect your wealth is to deploy them across multiple assets. Our view is holding cash or even fixed income is actually a tactical or a short-term view. If one were to take a 5, 10, 15-year view, you would need exposure to equities, commodities, REITs, real estate, gold, international asset classes in various forms to protect or grow your wealth. And every investor, we believe, would be better off focusing on these aspects, keeping an overarching view that fiat currencies are losing value every day as governments keep increasing deficits, keep printing currencies. Finally, wealth creation remains a long game of patience. In our view, it will have its own cycle. It will go through its ups and downs. Our last year and a half have been quite positive. We are fairly sure in the next few years we will see a downtrend or underperformance in some form. But so long as we have time on our side, we have a long-term vision, long-term perspective. We are very confident of creating sustainable wealth for investors. Thanks so much. I think with this, I will stop and leave the floor open for Q&A. I'm sure you have a lot of questions that are running in your mind. Would love to try and see where and if we are able to give some sense to, or at least present our views on multiple questions that we may have. Thanks.